Hi, everyone. I want to welcome you to our presentation today and our guest speaker, Marc Halpern. I've known Marc for almost 2 decades. I met him and he was an accomplished chemist in his own right and dabbled in real estate at the time. Since then, Marc has authored several books, both in chemistry and real estate. He has patents. He's opened up self-directed IRA accounts and 401ks. He's continually grown and evolved into a sophisticated and accredited investor. His journey is a definition of the life cycle, as there is no such thing as a set it and forget it system there. You can get close, but it just doesn't happen because technology changes, regulations change. And from that standpoint, your age and your lifestyle and your kids and your grandkids and your parents, all at different times need your caring and time associated with that. So with all that you do in the chemistry and real estate environment and traveling throughout the world, I think you're a perfect example of how you can integrate financial freedom and the things you love to do and to spend time with the people that you do. So at this point, Marc has a proven method and a track record, and he teaches others so that all can benefit. And he puts together groups that work together and come up with solutions faster together because of the time constraints we find as we get older. But I think it's more advantageous to turn this over to Marc than to continue on with all the accolades, because you'll gain a lot more information and you'll be able to see his prowess in both real estate and philosophy and the way he approaches problems. So Marc, if you would, please tell us some interesting things here today.
Carl, thank you so much for inviting me to speak here with the CAM Academy webinar. I also want to thank you personally for all you do for the self-directed IRA community. We've known each other, like you say, for nearly 2 decades, but one of the defining moments for me was on the National RIA Cruise in 2009, where you actually invested 3 hours with me on the cruise just to talk about CAMA and the previous version of it. And I've been now with CAMA for a very long time. And my self-directed Roth 401k, my self-directed 401k at CAMA, especially the Roth part, which I'm going to be mentioning a lot today, is a really very integral part. So thank you for all you've done for me as a friend, but also for the more importantly for the entire community. And I really appreciate it.
You're welcome. But if I spent 3 hours, you were probably buying drinks.
You know, with me, it's not hard to talk for 3 hours. So the way that it goes. Okay. So yeah, so today we're going to be talking about high return or best practices in high return private placement investing. And the slides I'm going to be showing are from a course which I'm going to be actually giving publicly for the first time. I've been doing it privately for a while, but I'm going to be doing it at CAMA Academy on September 30th this year. So, and if that works out well, we might even do others. So that I know this is recorded, so that, you might be watching this in 2025. So enjoy this presentation. So again, it's best practice about for private placement investing. And just as a little bit of a preview, I see private placement investing, like Carl said, I don't really rest on my laurels too much. Actually, when on my 30th birthday, I was actually under the federal poverty level with my wife and son at the time. So we went from zero to financial viability by getting a job. And then I actually started investing in real estate at age 50. And I was able to achieve financial freedom through a strategy which might be called buy, fix, rent, and sell as a single family homes. But then once you get the magic status of accredited investor, that's when you can get rid of all the tenants and the contractors, and I don't even have any employees anymore. And then you can make this transition to what I call the ultimate passive investor endgame, which is simultaneous financial and psychological freedom. well, nobody, nobody reports to you, and you have no responsibility for nobody. Your only responsibility is to manage a portfolio of private placement investments, and that's what we're going to be talking about here today. And by the way, I still am. My primary occupation still is in the field of chemistry. So I've been doing this part-time. Actually, it's named my company is Part-Time Investors. So I show people how to do this part-time. You can do it full-time if you want, but I enjoy things other than investing. Although I have to say, private placements on a scale of 1 to 10 is a 9.5 for me. I love the transition that I made into private placements. Okay, so just a few characteristics about private placements. One, they're private. People ask me sometimes, oh, where's their website? I can get all the private placements. Okay, the word private means there is no website that you can go to and get all this stuff. They're private. You usually have to, not always, but you usually have to be an accredited investor. And I'm going to show later how to get access to the private placement offerings. Another characteristic of private placements is the high return. And as I'll be mentioning later, I pretty much target returns in the area in the range of 15 to 30% compounded annual growth rate, although you can lose money and you can lose all your money. And that's why risk management is absolutely crucial, absolutely crucial. And how crucial is it? Well, you really need to do deep due diligence. People say, oh, you do due diligence. For me, the word due diligence has to be preceded by the word deep in underlined, capital, bold. It always has to be. And there are two types of due diligence that we do. We do due diligence on the deal fundamentals, on the opportunities and the risks, but also on the management. And the way I do it is 2 levels of operations. So it's like the upper management and then the operator level. And people say, oh, we bet on the jockey. Well, I actually have a project that's got a great jockey and a terrible horse, and it's not performing. And I'm going to mention that one. But you have to bet on the jockey and the horse, and you have to do deep due diligence on both the jockey and the horse.
Mark,
yes, please.
you were when you first started out, were very much wanted to control of almost all your investments. So what I'm looking at from this point is it looks like you're trading some of that control for a deep due diligence to make sure that the control is as good as you would do or better.
That is 100% on target. That's exactly right. Because yes, control is something that I value a lot. And if you don't, for those of you who don't know me, ask my wife, she'll tell you. I mean, I want to control everything. So relinquishing control over the investment was really tough. But the only way to do it is to do deep due diligence, not just regular due diligence, because once you wire the money, you're done. You don't have any voting rights. It's illiquid. And I've had situations where things did not go perfectly. The track record is really good. What I'm going to show later, the strategy of portfolio-wide management. That's the important thing. And but you're absolutely right. I am a control freak, and the way I control it is in the due diligence part. And then after that, there is some risk. And but the beauty when you do deep due diligence, which is different in private placements, which is different than what's available to the public. Usually have high risk, high return, medium risk, medium return, low risk, low return. But the public, I have a slide where I have a picture of the stock market here, the Wall Street casino. And you can do due diligence on Nike or Apple stock if you want, but in the end, the market goes up and down. In the private placements, you have access to information where you can, let's say it's an apartment syndication, you can go really deep. You can understand everything about that apartment syndication that's humanly possible. You can't know things that are unknown. If an asteroid hits and you don't have asteroid insurance, well, that's an issue. But for the most part, you can control 95% of what's going on. And that's why the return to risk ratio in private placements is much higher than that in public if you do your due diligence, if you do your deep due diligence. If you don't do your deep due diligence, your risk return might be worse than public because you don't know what you're doing. But that was a great question, Carl. Great comment. Now, here's just some things I want to mention. Opportunities always exist. For those of you who are in real estate, say a seller's market is hard to buy, single family homes, but there are always opportunities. So opportunities always do exist, and in good markets, in bad markets, in balanced markets, all kinds of markets. So you need to find those opportunities. And I typically target, again, the 15 to 30% compounded annual growth rate. Sometimes it goes higher, sometimes it goes lower, but that's what I'm targeting. And the other thing that always exists are best in class sponsors, syndicators, fund managers, and project sponsors. When I say first order, I mean the people that are actually doing the project. I'm not talking about somebody who you give money to and then they invest in somebody else, and they invest in somebody else, and you have all these arbitrage things going on. I don't invest in arbitrage kind of funds. But so if opportunities always exist and best in class sponsors always exist, then if you do deep due diligence on the jockey and the horse every time, then your portfolio will look good as a portfolio. But please understand, some deals will underperform no matter how much deep due diligence you do. So really, it's a question of portfolio management. So you manage each individual jockey and horse, and then you manage portfolio. The biggest challenge for a lot of people is the patience to do deep due diligence. So you're squeezed in the middle between, I don't feel like reading this 160-page private placement memorandum and all the associated documents. The reason why you need to have that patience, the deep due diligence, is because you want the high return, and it's passive. Didn't mention this really yet, but I guess the main reason why I went into private placements was not the returns. I actually thought I was going to be compromising on the returns. I was doing it so I can have passive income, truly passive income, and truly passive growth. Now, when I say truly passive, I had a bunch of rentals. I still have two. I'm trying to get rid of them. Rentals, self-managed rentals, is semi-passive income at best. And there are times, like when you have a sewer break, well, it's not passive at that moment. And if you have property managers, you still have to manage a property manager. What we're talking about in private placements, these are truly passive once you wire the money. So I strongly urge you to do deep due diligence, and you need the patience for that. So that's a psychological thing. The number one key to success, in my never humble opinion, in private placement investing is risk management. So typically, there are three types of investors. There's ready, aim, fire. That's the good, and that's the way people usually do things. There's ready, fire, aim, which is, I've seen real estate investors and other investors do this. If you don't read the PPM, that's ready, fire, aim. And then there's ready, aim, 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 aim. That's analysis paralysis. I have a slightly different approach, which is ready, aim, 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 fire. I do pull the trigger, but I do about 3 times more due diligence than just about anybody else. So deep due diligence is absolutely crucial to be successful in private placement investing. Although you can get lucky. And I mean, prayer and luck and hope, they work, but I think Carl once said that hope is not an investment strategy. Carl, you're the one that told me that.
I did. That's exactly right.
Yep.
That's what I saw. I saw a bunch of our clients, they would take their 401ks or IRAs and they'd throw their statements into the drawer until they handed them to their accountants. I said, "What's on your retirement plans?" "I don't know. I don't look at it. I'm just hoping it's good when I get there."
Yeah. So I think that this, well, self-serving, but the course and the training today, which I'm giving some best practices, this is good for maybe, some Camel Clan clients and other people that maybe haven't done as much due diligence. I've been approached in the last few months by people that say, yeah, I have these private placements. I need to understand better how to do the due diligence. I mean, if you're making 15 to 30% returns, and if you're going to be holding on to these things for years, is it worthwhile doing 10 or 15 hours of deep due diligence? So I do all my work up front, and it's worth it. And and even when I was, let's say, was flipping houses or rentals, I didn't put 10 hours of work initially to study the neighborhood and screening tenants and all the preparation. But then it was only semi-passive after that. So I just take the front end work and I put it. It's pretty much all the front end work. So again, I'm showing you selected slides from this presentation from the full day course that's going to be done in Cam Academy on September 30th. And sections 3, 4, and 5 are the biggest ones. And I start with risk management basics. So just a few best practices when it comes to risk management. So there's a thing called the private placement memorandum. It's actually usually about 1/3 to 1/2 of the documentation that you get. But private placement memorandum is where a lot of detail in there. And it's extremely important to do deep due diligence. Now, what do I mean by deep due diligence? And some of you are going to balk at this. And I'm telling you, I do this. Most people don't. I do it. This is what I teach. I strongly recommend that everybody does this. You read every word. If it's 162 pages, well, you read every word. Understand every risk. That's probably more crucial than anything else. Understand every assumption. Again, it takes a few hours to do this. Understand every spreadsheet. Understand who gets paid, when, and how much. There's, the syndicators, the project sponsors, when you get paid, what a preferred return is, what happens upon exit, what kind of acquisition fees and disposition fees there are. I want to mention something which I just learned about really in recent months. It's called the Van Halen Brown M&M clause. Carl, have you heard of this?
I don't think so. I'm waiting to hear it.
Okay, all right.
I like Van Halen and M&Ms.
Well, there you go. So, this is I actually finally met somebody else who actually heard of it, and when it's a great story, and I'm not sure how am I doing on the time. It doesn't matter. I want to tell the story. So, Van Halen, they have equipment that's very, very heavy, and apparently they had a situation where the equipment was so heavy that the stage in one of the venues they were at was not good enough and collapsed and did tens of thousands of dollars of damage. So they put in their contract that this stage has to be sturdy enough to handle all this stuff. But people don't read contracts, just like people don't read PPMs. Actually, a syndicator who I will not mention told me a couple of months ago that 90% of their investors in their fund do not read the PPM, and 95% don't do deep due diligence. So this is why I came up with this with the story for the. I didn't come up with sharing the story. So what Van Halen did in their contract, so they have one part where they say here's how the stage has to be set up and all the parameters for the engineering parameters. But then they also said that in the green room, they want to have, when they arrive, they want to have brown M&Ms. Sorry, they want to have a bowl of M&Ms in the room. And the clause then has a subclause that says, and there shall be no brown M&Ms in there. Now, bands are known for all kinds of crazy things that they ask for. And a bowl of M&Ms, okay. So what they would do is before they bring the equipment in, they go into the green room, they take a look and they see, number one, is there a bowl of M&Ms? And number two, are there any brown ones in there? Because if there's M&Ms, if there are M&Ms there, but there are brown ones, that means they didn't read the contract in detail. And that's a very interesting way of seeding a contract, putting a seed in there to see are people reading it or not. So I really recommend that you read the private placement memorandum where you're about to send in $50,000, $100,000, $250,000. I strongly recommend that you read the contract the way Van Halen expects their venues to read the contract. So this is I have to sanitize things so you can't identify which PPM it's from. But this is an actual screenshot of part of a PPM that starts with the risk factors. Now, the particular PPM example that I took this from, the total package is 162 pages of the total document package. And in this one, the PPM itself was 63 pages, and 10 pages out of the 63 pages is a description of risk factors. And there are 23 risks cited, and each one has got a paragraph. So there are 23 of these risks over a 10-page, and each one have a couple of paragraphs. By the way, in this, out of the 162 pages, 38 pages were the LLC operating agreement. So it is very important. I'm strongly recommending that you read every word. But if you're going to skimp, and I recommend that you don't skimp, but if you can read anything in great detail, read every one of the risk factors. You have to. And if you don't, you're doing yourself a disservice. I mean, does it matter to me? Well, it matters to you. It's your money. So you read all the risks, and just a tip which I've been recommending, which I do myself, is I always attempt to identify at least one risk that is not identified in the PPM. Now that's hard to do, because all the king's horses and all the king's men got together of the syndicator or fund manager or project sponsor to try and identify every risk that's possible. But there are certain risks that are like hurricanes and earthquakes or
pandemics.
What's that?
Pandemics.
Yeah, pandemics. That's right. Exactly. And now actually COVID-19 is usually one of the first risks that's there, but who knows what other pandemics can be there. Pandemics is a perfect example. So yeah, and who can identify such a risk? And I've been joking for years about an asteroid hits and there's no asteroid insurance. But I invested in a farm in Paraguay. My Roth invested in a farm in Paraguay, and I didn't want to invest because of corruption in Paraguay. And eventually I did my deep due diligence on the political stability of the Paraguayan government in the last 5 years before I invested. So there are a few things which you do. And then another tip, which I strongly recommend, which I do, is I write down every crucial risk. I actually write it down. Many times I'll put it in a computer file, but sometimes I'll actually write it down on a piece of paper. And then write down the risk mitigation in writing. It's got to be in writing. If it ain't writ, it ain't thunk. I learned that at Wharton Business School many years ago, and a really cool course I got for $50 for 10 hours. Anyway, so that's part of deep due diligence on the deal. But the deep due diligence on the people, I've come up with a list of best-in-class characteristics, because there are all kinds of syndicators and fund managers and project sponsors out there, and some of them are good. Some of them are excellent. A few of them are best in class, and some are scam artists. I wouldn't say they're all scam artists. They're not. But the top 5% are experienced with excellent track record in that sector. So, for example, I saw something recently where, guys doing motel to apartment conversions, and he's done, 3 motel to apartment conversions. He also did 150 flips. The 150 single family home flips are nice, but I'm looking at the motel to apartment conversion aspect of it. So I want to see excellent track record in that sector. Transparent and comprehensive. They have to be totally transparent. Best in class apartment syndicator I know sends out a 50-page update every quarter with the bank statements. And this like for a 1,000-unit apartment complex. So it's a lot of detail in there. And I want them to be upfront about risks and negatives. I don't want to hear just positive the whole time. Personal integrity. And we're talking about the people that are managing it, but also the people at the operational level. I was once going to invest in a precious metal mine in Canada, and everything was great. It was fantastic. And then I got to speak with the technical lead, and the technical lead said he wouldn't give me the name or the number of the patent that was the competitive advantage that this thing was based on. Well, that was not transparency for me. If they're hiding a patent number, which is public information, what else are they going to hide from me? And personal integrity, access to key performers. I might put on $100,000 in a $35 million raise, and I want to speak with the guy in charge or the gal in charge and the operators, and I want to get referrals. And sometimes for funds, they're third-party auditors like Verivest for certain funds. So these are best-in-class characteristics that I'm always looking for. A very, very important thing which I do is I diversify in 3 dimensions, which is soon to be 4, but it's right now it's 3 dimensions, which is multiple projects in multiple sectors with multiple syndicators, fund managers, and project sponsors. And I'm going to actually disclose what's in my self-directed Roth 401k account plan right now. These are the 10 projects that are in my Roth right now in August, I guess, of 2023. So there you can see 10 different projects in there, and the first 3 are in their apartment sectors, and then I have several other sectors, student housing, mixed commercial, self-storage, land development, farm, resort, and bridge loan. And so there's 10 projects in 8 sectors with 6 different sponsors. So you can see the yellow is number 1. So this apartments number 1 and the farm and the resort are with the same sponsor. And apartments number 3, student housing and the mixed commercial fund are also with 1 sponsor. But altogether I have 6 sponsors. So if I get hit with the Bernie Madoff, or if something happens like the resort, the resort that is not performing, that's the one here that's not performing. I don't think I'm going to lose money, but I don't even see a runway for when we're going to get any kind of return there. So if one of them if a project goes bad, or an entire sector goes bad, or a sponsor goes bad, I don't lose everything. I don't even lose a lot. The portfolio as a whole is still in very good shape. And some people say, hey, student housing, that's like apartments. No, very, very different drivers, very, very different driving forces. COVID, actually, student housing, if you was one person in a room, that was a major advantage. So when bad things happen, a lot of people suffer, but then certain sectors actually benefit more, like self-storage. Self-storage, when things are good, self-storage is good. And when things are bad, self-storage is better because people are downsizing or getting evicted and they need a place to store stuff. So, and again, a farm overseas, a resort overseas, very, very different than a bridge loan, or different than self-storage, different than apartments. And then another thing, excuse me, nothing is, you always want to ask, what if? What if I lose 100% of this current project that I'm looking at? And that's why a lot of people say you shouldn't invest more than 10% of your net worth in one deal. And I try to keep that 5%. And when I say try, I actually, in all cases, except one, because I was looking for something very, very special. And it was a great 12% preferred return and an income fund. So I actually went above, I went above 5%. I did not go above 10% though. So if you have a well-diversified portfolio and you don't invest more than 5% of your net worth in one deal, then that's a good thing. Now, so how do you get, sorry, I'm skipping to section 9. These are the best practices, which I'm talking about here. So I'm really, giving the most important highlights from this course. How to access private placement opportunities. And the answer is networking, networking, networking. And it's funny because I think that the people that are listed here, I met through Kama Academy. I certainly met Alina. Carl, remember you interviewed Alina, and then she's great. She's fantastic. And she has a meetup called The Power of Passive Investing. Sometimes it's online, sometimes it's in person. Excuse me. Anthony Chara's course on apartment investing is fantastic. 30 to 40% of my Roth investments are usually in apartments complexes and apartment syndications. And Anthony Chara's course is a great place because not only do you learn how to do the apartment investing, but like the one I went to, there were 52 people. And out of those 52 people, 45 were wannabe syndicators, and 5 will become best in class. And you get to network with all these people. Ultra high net worth conferences. And this also came through you in Kama Academy. I didn't know about the Family Office Club, and I saw Richard Wilson for the first time on one of your webinars, the Kama Plan webinars. And then we really hit it off, and now I'm going to be presenting for the 6th time at a Family Office Club in Fort Lauderdale, and maybe I'll come visit you, Carl, down in Fort Lauderdale there in September and in December for the Super Summit. These are just tremendously great places. And of course, the private placement training when you come to my course. And I'll have a new thing called the Part-Time Investor Alliance, which I actually just set up in May of this year because too many, actually one reason why I'm doing the course instead of the private coaching is that there's too much demand for it. It turns out that there hasn't been any really good training for private placement investing, except for people that are trying to convince you to invest in their private placement. So that's why I'm sharing what my perspectives are with the experience that I now have. And the Part-Time Investor Alliance is, and anybody who comes to my course or has done my one-on-one coaching, I'm now stopping that, are people that have the mental bandwidth for deep due diligence. I know that sounds strange, but that's maybe tops 10% of the investors are willing to do this kind of deep due diligence. So the Part-Time Investor Alliance are people that are like-minded with you, that are people that are willing to do deep due diligence. And some of you on the call today, you might not be willing to do the deep due diligence, in which case you shouldn't come to my course and you won't be a part of our alliance. And what's nice about the alliance, we have several different things. Well, first of all, I get a lot of deal flow. Actually, after the last presentation that I made at a Family Office Club, I'm typically getting more than 1 pitch per day, which is a lot. So there's a whole system with 1-pagers, and I know, Carl, you've been on panels with me where we would look at 1-pagers, to say what's good and bad about those things. So I share access to the 1-pagers that I get through a private Dropbox file that's members only, and the other members can also share access to their private placements. Of course, the one page only to the non-confidential parts of it. Then we started a private unlisted LinkedIn group. So you can't find it. You have to be a member to be invited to get there. And it's really great for networking and to collaborate to perform deep due diligence. So since all the members are into deep due diligence, then people will say, hey, have you looked at the motels to apartment conversion? Have you looked at Outpost Ventures with the military dual use stuff? Have you looked at these things? And three people might get together and say, yeah, I'm interested in that. Let's do some deep due diligence together. And since they've all been trained on deep due diligence, then it really works out well.
Well, the other thing, Mark, by attending some of the sessions and the calls, people have to start off with a basic understanding. Otherwise, they'll get lost in the deep due diligence process when they're talking about that and when they're sharing ideas. And you and I both know, by sharing and having many eyes look at a offering or a deal, people come in from it at different perspectives, and it's definitely a good system that's set up at this point. But people do have to have a basic knowledge of where the group is going and in what type of investments.
Yeah, and perfect. That's thank you very much for saying that. That is really reinforces this message that like-minded people that do deep due diligence as opposed to tire kickers. So I'm not saying there are no tire kickers in the Part-Time Investors Alliance, but I'm thinking about it. I don't think we have any tire kickers in there, because somebody who's willing to invest in going to the course, but not just the money, but sitting through the hour. I mean, I talk about risk management for these 10 different private placements. I actually mention each one of the risks for each one of the 10 private placements. It's not easy after lunch to sit there and listen to this, but if you're willing to do that, that's a barrier to entry. And so I'm trying to scare people from not taking the course, but I'm also trying to scare people for not doing deep due diligence, because you can lose money. So yeah, you're right. It's really good in these meetings that we have with syndicators. And that's the next thing, is the meetings. We have meetings between members and meetings with syndicators, and also meetings at Family Office Club Super Summit and the Summit. So for example, in May, just before I set this up, I had a bunch of my coaching clients came with me to Brooklyn, New York, to the summit. We had, I think, 5 of my coaching clients that came with me. And then when Richard Wilson, Laura Clay invited me to visit with syndicators and fund managers and project sponsors for specific deals, I said, do you mind if I bring my colleagues? And they loved it, because they got to see me in action, grilling the living daylights out of these project sponsors and syndicators. And then some of them started flexing their muscles and asking questions themselves. They found this so exhilarating. I think that these meetings I think there's nothing better than the Family Office Club. It's the major leagues. RIAs are, I used to say minor leagues, but it's really like little league relative to the Family Office Club. It's really a great place to go. And then if we get 10 or more Part-Time Investor Alliance members, Richard Wilson actually said that we would have let's say a special room for lunch. They would come and address us, and of course we would get access. We'd be treated as inner circle. So this is a good thing.
Well, we'll see you in Fort Lauderdale.
Oh yes, absolutely. Yeah, I'm gonna be in Fort Lauderdale, and I'm probably also speaking at the Family Office Mastermind in New York in October. So I also might be going to the one in San Francisco on September 7th, the day before the National RIA Cruise. So anybody who's new on the National RIA Cruise, I'll be seeing you there. So again, I put together this course it's for private investors. It's really for private accredited investors. I mean, if you're not an accredited investor, you're a sophisticated investor, I guess you can come to it, but you're not going to have as much access as accredited investors. So this is really good for accredited investors. And there's an introduction. I talk about the common categories of private placement investments, setting your expectations, which is what are the target metrics, but also talking about the difference between growth and income. The risk management basics, that's a big section there. I showed a few of the slides from there. Talk about the documentation. I then go through a very detailed analysis of a specific apartment syndication for a few reasons. Number one, apartment syndications are the most common kind of private placement that's out there. It's also the easiest to identify and easiest to really screen and perform deep due diligence on. And then,
So Mark, if people do have questions, should they put them in the chat box?
yes, that would be very
If
good.
they have time? Okay, we
Yeah.
didn't announce that in
Yeah,
the beginning.
yes, and I think we'll have time for Q&A because I don't have that many more slides here, and then diversifying the private placement investment portfolio. So the 10 investments that I showed you, they're in my Roth. We go into deep detail, including risk management, key risks, and mitigation for every one of them. And then I also, section 7, short, I talk about high risk private venture investing. Section 8 is somewhat amusing. I talk about 10 examples of deals that I rejected. Section 9 is how to access private placement investment opportunities. Section 10 brings the whole thing together in what's the entire process from soup to nuts of the private placement investing. And then if you want to register for the course, that's going to be on September 30th. There's a special discount of $500 for Account Plan clients. Instead of $19.97, it's $14.97. And you go to parttimeinvestors.com, click on the events tab, and it's right there. Or you can use this QR code. So at this point, I think that is the end of my presentation. So if there are any questions, and Carl, maybe you can moderate those in the chat, then I won't have to go look at them.
I will try to do that. So one of your questions, or one of the things in the deep due diligence is you found that you're running out of time with taking care of your mom, doing your chemistry, etc. And I came in on the tail end of it, but you have a group already that are the PTI, or the part-time investors, that are helping look at these deals that are coming into the group. They bring deals in, you bring deals in, and then everybody sits down and looks at these deals and then decides whether or not they want to do this. But also, you were talking about possibly everybody to meet minimums on certain of these things. They could do a tribe vest and
Yes.
you know, because I see that you're so risk adverse that you know, I call it toe dipping, where you put your toe in before you jump in. So if you have this group of investors, you know where I'm going with the tribe vest?
Yes, yeah, that's great. Carl, I'm really glad that you brought that up. I actually need to add that into the course materials. Yeah, sometimes there's some deals that are really good that have a minimum investment of $1 million. I don't have $1 million to invest, and if I had $1 million to invest, which I might after an IPO we're expecting next year, then I still wouldn't invest $1 million because I want to diversify. I don't want to put more than five. Well, I guess when $1 million becomes 5% of my net worth, we'll talk about it then. So there's a thing called tribe vest, and Carl, really thank you for bringing that up, where you can. It's a group of people that get together and form a tribe, what's called, to meet the minimum, and you get better terms. So, for example, one of the deals that I'm invested in, I'm getting a 60-40 split on the equity side of the LLC. If I had $1 million, I'd be getting an 80-20 split. So there's a 60-40, 65-35, 7. So depending on what the level is that you come in at, you get different equity splits and different, and higher returns on investment. So the tribe vest is a way. And I think it was like, what, $150 per person. That's all to set up this LLC, and then the LLC invests as a tribe, what they call, and then you get better terms. So there's so many different things once you get into this world. For those of you who are not yet into the world of private placement investing, and like especially for people that have 30 rentals, a lot of my clients are people that have. They have 30 rentals. Oh, I've arrived. I have financial freedom. Okay, you have psychological freedom, and so
and you have time freedom.
And exactly, the time freedom is the issue. And one reason why I have 4 primary occupations and 2 secondary occupations is because I don't do active real estate investing anymore, other than the 2 rentals that I have that I'm getting rid of, because I now have time to do what it is that I want, because I've moved most of my investments to private placements. It's just so much more passive.
And can you tell us what a accredited investor is?
Yes, so accredited investor. Oh, I probably should have started with a disclaimer. I'm a chemist. I'm not a licensed accountant, not a licensed attorney, not a licensed financial advisor, not a licensed psychologist. Even though I've written books on my next book called Now Be Happier is coming out this month. Anyway. So don't take financial or legal advice from a chemist, but it is my understanding that an accredited investor is there are two different criteria, which might be changing at some point here in the future. But for now, and the criterion that most of us use that are in the group in the Part-Time Investor Alliance is a net worth of $1 million or more, excluding the equity in your primary residence. Another way of being an accredited investor is that you have, if you have 200,000 in income, consistent income per year, if you're single, or 300,000 per for a couple. But an accredited investor, so once you get to this magic number of $1,001 of net worth that can be verified by an accountant, by your CPA, that's when you become an accredited investor, and that's when you don't have to do single family home investing anymore. You don't have to be an active real estate investor. You can get rid of it. Now, some people enjoy. I know somebody's got 150 rentals and he loves it. He loves it. And that's not my idea of enjoyment, but different people, different strokes for different folks. So, but that's an accredited investor. It's a magic golden ticket into private placements.
Okay, the other thing is somebody said that we might have the chat box disabled. If you can't hit the chat box, hit the Q&A and we'll answer that. The questions in there, I'll look at both of those. And the other question was there's not a place that you can go to for for private placements out there on the internet. And part of that is true, part of it isn't, because there's Reg CF, there's Reg A, there's Reg D. So
right.
Some of those you can find, but all the investment options are a little bit different. And I don't really want to go into that today.
Yeah, like Grant Cardone stuff, I think he's got, he filed all the kind of thing. But for most of what they call the 506Bs and Cs, and I'm mostly 506C, yeah, it's yeah. And there are places you can go. There's a thing called Left Field Investors, who I encourage everybody to become a member of Left Field Investors. If you're an accredited investor, because they also have things like the Part-Time Investor Alliance. And the difference is that they don't put the kind of emphasis that I do on deep due diligence.
One question came in, and I'll let you answer it. I've got my own answer, but is there any extra due diligence or less due diligence you would do if you were looking for personal funds versus a self-directed IRA or 401k?
For me, I mean, there might be some small logistics differences. But in terms of the deep due diligence, I do the deep due diligence. Obviously there's certain things that there are prohibited transactions. So if you are, let's say, for example, I guess if you're the syndicator, okay, I don't think you can invest in your own syndication with your self-directed IRA funds, and maybe I'll defer to Carl on that. But and sometimes in foreign investments, so like the farm that I have that my Roth is invested in Paraguay, it's really invested in an LLC that's based in the United States. So there's all kinds of tax ramifications. But in terms of the deep due diligence on the fundamentals of the deal, and deep due diligence on the fundamentals of the sponsors, I really don't treat them any differently.
No, I would hate to lose Roth money because I'm not really going to get a deduction for it, if I did make a mistake. So I would say everything that you do for your personal, you should do for your Roth, and maybe a little bit more. But I don't want to lose my personal money either.
Yeah.
But Eric picks up a good question. Amber's pretty far. What time is the class set for on September 30th?
Oh, okay. Yeah, it's registration starts at 8:30, 8:45. We'll start. It's probably gonna be a 9 o'clock hard start. But I might, if everybody's there, we might start at 8:45, and it's gonna go till 5. But if Cam Academy is open, it's, as you can probably tell, it's not hard to get me to talk. So people have questions, I'll probably stay till midnight or till late they throw me out. Oh, I do want to mention one thing, back to the previous question. There are some private placements that, especially like oil and gas and other and even apartment syndication that I've seen, where one of the major benefits is to take a depreciation write-off. So now that I think of it, when you sometimes, and like one of the deals that my Roth is invested in, there's actually a class A1 and a class A2, and the difference is that one of the classes gets all the depreciation less than the back end, and then people like me, self-directed IRA investors, we don't care about the depreciation because we can't benefit from that because we're not paying taxes. So in some syndications actually have and funds and project sponsors, they have allowances and different classes of investors depending if you want to take depreciation or not. So Carl, you said something that sparked that thought in my mind, so I want to thank you for sparking that.
No problem. The other side, though, depreciation, they give it and then you got to pay it back too.
Yeah.
So it's it's not as good as a tax defer. I mean, a tax free. It's basically tax deferred. So
yeah, people always ask that and say, "Oh, you don't get the deduction of self-directed IRA." What part of tax free do you not understand in the Roth? And then in a 401k, it's tax deferred. So it's matter of fact, Carl, you and I think we have a joint lecture from 2017 on the differences between self-directed IRAs and self-directed. Hard to believe it's been 6 years. Yeah, and 401ks. Yeah. So.
And I think we've got it summarized on our website too. If you go into there and talk and look under things, self-directed IRAs versus 401ks. Here's another question. Can you do a real estate to syndication 1031 exchange?
Great question. So at a year and a half ago, I was at a summit. It's a super summit, and I was talking with the fund manager. It was funny. I only invested, I think it was 155,000, and it was a very small raise of 11 million, and I put 155,000, mostly out of my Roth, some out of my pre-tax 401k, all account plan. And they took me out to dinner. Why would they take me out to dinner? There was literally 1,500 people, 500 online, 1,000 in person, at least 100, 200 people net worth above 20 million. Why would they take me? I don't have a net worth anywhere, near that. And he said that he sort of liked the way that I do the due diligence because I ask him more questions than most other people. And then I asked him about this. He asked about the 1031. He was talking about 1031 exchanges. He's got several $100 million assets under management. And I said, well, 1031 exchange, I'm not a big believer in it because I have my self-directed 401k. The pre-tax part, I'd much rather do it that way. And then at that point, he said, but all your clients don't have that. And I said, well, that's true. And it turns out that this particular fund manager, some of the projects they have are 1031 exchangeable. Not all, most are not, but there are certain ones that are. So,
and you can look for those, and a lot of the Delaware statutory trusts will help you with the 1031s. Another question is, why are you selling your real estate investment? And I'm assuming that's your 2 rental properties left, Mark.
So great question. So the major answer is for psychological freedom. I don't want to deal with another sewer break. It's that simple. And when I first when I started divesting out of my rentals, which, by the way, I was owning in my Roth, my self-directed Roth 401k. I actually had some in my self-directed pre-tax 401k, and I really I just didn't want to have any management involved. And when I first did that, I was saying, you know what, I'm going to get these private placements, and I'm probably going to have to compromise on my returns, both in terms of cash flow and growth. And I was shocked to find out that I didn't have to compromise on cash flow and growth. The cash flow is called preferred return in private placements, and then the growth was actually really, really good. But the major reason I did it is it wasn't to increase my returns, it was to have more psychological freedom. And then as I got into it and I did my deep due diligence, and like the first exit that I had was a 28.6% compounded annual growth rate, was actually a 53.3% IRR, but you'd have to redeploy immediately to take advantage. But the reason why I did that is because I just didn't want to manage property managers anymore, and I don't want to manage tenants individually anymore. I don't want to manage contractors. I don't want to manage code officials. I don't want to manage anything. I don't want to manage people. I want to manage a portfolio. That's my personal, different strokes, different folks. Some people.
No, but Mark, you loved them 15 years ago, right? And now you're taking care of, your parents and, and a couple of those things.
That's right. And
going along the way. So.
And why did I love them? I love them because I was going from financial viability as being just a chemist to financial freedom.
Yeah.
And
so
I still teach that. I still teach that. So if people want to get there.
So yeah, for people who came on late, we will have a recording on this. It'll most definitely be out within the week, maybe sooner. Check back with us at Camaplan and we'll let you know. And then LS has a question. Why is there always your prices, 1,97 instead of 1,500?
Oh yes, so that it's in fact this was going to be 2,000 and 1,500, and then at the last second I said, you know what, all the other speakers. I mean, I have I have a home study course. It's called the Smart Investing Home Study Course, at 27.5 hours of training how to go from financial viability to financial freedom, and that used to be $997, and then when it got bigger, it's $1,197. It's the way that everybody does it, and there's all kinds of research that says, why do you have a 99-cent store and not the dollar store? It's it would feel more.
Okay, I just wanted to answer him on that question. So, let me see. Do we have other ones here? All right. So your class is at on September 30th at the CAMA offices at the Academy upstairs. You're going to serve lunch, and it's going to go from 8:30 or 9 to 5. How do they sign up? We showed that screen already with that QR code, right?
Yep, and we showed that screen. And then if you actually go to the website, which is parttimeinvestors.com, and go to the events tab. So you go to it says Part-Time Investors LLC. If that's okay. Go to parttimeinvestors.com. That'll take you there. And then it has the information here. And then just go to the registration. And then once you register. And then there'll be a question on the next page that'll say, are you a Camaplan client? If so, you get the $500 discount. And that'll be the way to register. And and again, one of the most important valuable items, it isn't just the training, it's the alliance afterwards.
Gotcha.
And when you get to interact with all the other people that have gone through the deep due diligence, and you can collaborate with them on due diligence, but also, the private LinkedIn group. I would like to share a screen with that, but it would disclose some of the members, and you have to be a member to know who the other members are. Then people are saying, what do you think about this one? What do you think about that one? There's a webinar coming up on Monday. Are you going to attend it? Or there's going to be a tour of a self-storage thing in Princeton. Would you like to, how about a bunch of us meet this guy, or somebody's coming up from Maryland, let's go out to lunch. It's the alliance has great value. And then if you join me to the either Super Summit or a summit, the Super Summit is usually in Fort Lauderdale, and the summit is usually in New York. Then you get to meet with direct syndicators. It's a tremendous experience. So there's the benefits of being a Part-Time Investor Alliance member. That outlasts the hours of training that you get.
Well, I number one, I appreciate you giving us time today, Mark. Number two, I appreciate you offering the class because I am tired of people getting scammed, and then after they get scammed, then of course they want to go to the lawyers, and then it's expensive, and they've signed the paperwork, etc. So it's almost like, sign the paperwork and then start negotiating, and that's not the way I want our clients to be, because it doesn't end up in a good position. So I appreciate you offering this course for the people that want to do it. And thank you very much. And at that point, if you have any other questions, Mark, do you want to give out your email there, or have you already done that in some of the stuff or not?
Yes, it's funny. I believe it or not, I didn't even think about putting that on there. But my email address is Mark. That's MARC at parttimeinvestors.com. So that's Mark at parttimeinvestors.com. And really, I think what you might want to do here is just go to, whoops. We want to go to the parttimeinvestors.com, to the website, and you can always hit on the contact page there, and then that'll be there. Go to parttimeinvestors.com. There's also a contact us page. You can reach me that way. That's the best way. Carl, thank you so much for the opportunity to talk with the self-directed IRA community. And again, I've been with CapPlan for a long time. It's a place to be.
All right, thank you very much for those kind words. And again, I just want to say we're not attorneys, and this is Mark's opinion here. He's talked to you about his disclosure on this information, but it's people helping people. So thank you guys very much for attending, and Mark for presenting today. Have a good rest of your day.
Thank you very much. Be well.